Yo. Hello, guys. This is David Capable in the building, and today I have a very interesting topic to put you guys through. And this topic is a very amazing topic because it's a topic that is going to sharpen your analysis of the forex market. For you to be able to analyze the forex market, you need to listen to this particular topic, and your ability to grab to this particular topic will gives you an in-depth and sharpen your skills in analyzing the forex market. So today we're going to be talking about market structure. All right, so without further ado, let's go straight to what is market structure. Now, market structure by definition is simplest form of price movement in the market. All right, it is basically support and resistance level on the chart, swing highs and swing lows. These are levels which are easily identified and hold until they don't. Market structure is a trend following tool that traders read and follow based on how an asset moves, from bullish moves to bearish and in between ranges. Now, when you come across your forex chart, the first thing that you notice is that you discover that there is a movement like in the form of waves. All right, and there are some movement that are so predictory, and there are some that are not predictory, and there are some that looks very ranging in sand. As in, they look like zigzag like that. You'll be confused. A lot of people are confused. So the essence of this video is actually to tell you how you can actually understand how to actually analyze this particular price in your forex chart. When you log into your forex chart, you need to understand that there is what is called price movement. This price movement simply summarize what a market structure is. A market structure, in a nutshell, simply means the movement of price. How does a price move in markets? Or you simply put, how do price react? What are the action of price? How is the action of price? You also hear where people call it price action. So when you hear price action, it's simply talking about what? Market structure. So the action of price, how price acts in the market, is actually what is known as market structure. Is that understood? Now, price can actually move in different ways. It can be moving either upward, that is a bullish trend, or it can be coming downward, which is a bearish trend, or it could be moving maybe in between ranges. And in between ranges could either be a choppy or a ranging market. All right, and that leads us to our next slide, which is types of market structure. Now, a market structure or price action, or simply put, price movement can actually be in three forms. It's either a trendy market, a rangy market, or a choppy market. These are the three ways the price in your forex market moves. It's going to either be moving in a trendy way, or it's going to move in a ranging way, or it's going to be moving in a choppy market. In our subsequent slide, we're going to be seeing and explaining how this happens in your forex market with practical examples. All right, let's look at the next slide. Now, in the next slide, we have the trending market. A trending market are simply characterized by a repeating pattern of higher highs and higher lows in an up trending market, that is bullish market, and lower highs and lower lows in a trending market. Now, let me simply put it this way. In a trending market actually has two types. It's either is moving upward, which is an upward trend, which is bullish, or is coming down, which is bearish. So the first one we're going to be looking at under the trending market is actually the bullish trend. Now, in the bullish trend, we have series of what? Higher highs and series of higher lows. It consists of series of higher highs and higher lows. All right, that is the first trending market, which is called the bullish trend. And this is how it looks like. This is how the first trending market example, which is the uptrend. You can see an uptrend. You can see the higher high and low. We now have a higher high and higher low. They are actually abbreviated. The HH means higher high, while the HL means higher low. So we have a higher high and a higher low, a higher high, a higher low. This is an example of a trending market, which is categorized as what? As an uptrend. As an uptrend. Are you getting it? A trending market categorized as what? As an uptrend. Remember, okay? So the next trendy market will be what? A downtrend. Now, this is a downtrend, okay? It consists of what? Lower highs and lower lows. The LH means lower highs, while the LL means lower lows. You can see the market is coming downward. It's moving from what? Your left hand side, and it's coming down to your right hand side, going downward. So this is an example what? Of a downtrend. So look at it again. You can see small. You can see uptrend is going up. It's just going up. You see the market is going up. You can see the arrow showing. It's showing an uptrend. All right. Then look at it. Also a downtrend going down. These two categories fall under what? A trendy market. All right. Now we have the ranging market. Ranging market, guys. Ranging. Oh, you've come across what they say something is ranging. It means it's not being static. All right. It goes up, it comes down. It goes up, it comes down. It goes up, it comes down. That is what a ranging looks like. When something is ranging, something is roaring. It goes up, it comes down. All right. It's just like if there's a law of what do you call this particular law? Maybe there is a law of gravitation. All right. So this is also known as sideways market. A ranging market moves in a horizontal form. The buyers and sellers keep knocking price back and forth between the support and resistance level. Now, in ranging market, the market goes up and meets a particular place. It hits the resistance at the top and comes down at the base where the support zone is. So let's use a layman example. The roof of the house serves simply like the resistance, while the floor of the house serves like this support zone. Some people call it supply and demand. The supply is actually the resistance, while the demand is actually what? The support zone. Are you getting it? So when prices moves from up to down like that in a gravitational way, forming a sideways pattern where it keeps going back and forth, it means there is what? That price movement is what? Is a ranging market. Let's see example. Okay. This is how a ranging market is. You can see at the top where there is a blue line there, and also below it. So at the top, the resistance, below where there is two blue lines. As you can see, those blue lines in rectangular form, rectangular blue and light blue at the top is the resistance. The rectangular blue below it is actually what? Support. So this, when prices go in between this particular two blue lines, it's ranging. Okay, you actually see this kind of price movement in your forest chart. All right, is that understood? So let's go to the final type of market structure. Our final market structure type is called a chubby market. A chubby market occurs when buyers and sellers are in balance, or when buyers and sellers are in a fierce fight, but there isn't an overall winner. We could say the market conditions are indecisive, thus should be avoided for trading. Simple. In a chubby market, it is always advisable for you to avoid chubby market, because there is an element of indecision, no clarity of direction of the market. There is no clarity if the market is actually going up, bullish, or is coming down, bearish, or is even ranging within 2 points of support and resistance. So in this market, it's just baseless for you to trade this market. It's baseless. So you don't trade this market because you don't even know the direction the market is going. At this kind of market, most times what we do is that we traders, what we do is that we call it consolidation. Market is trying to consolidate, is trying to gather momentum. The market is trying to gather momentum. Is either it's going to break forth upward, bullish, or it's going to come down bearish. So that is how it is in choppy market. So when the market is gathering momentum, is gathering energy to take off, you don't rush. You just watch the market and see possible breakouts. All right. So that is why you have examples of a choppy market in like this. When you see choppy market, you don't rush them. You don't rush to trade. The market just goes up. It may not even hit the point of resistance, maybe close to it, and comes down, or may not even touch the point of support. So the market is just indecisive. There is no clarity about the direction of the market. So it's always advisable that you should avoid trading such kind of price movement in the market when you open your chart. All right. Okay. So something to take up home about the choppy market is that the choppy market can also be known as a period of consolidation, like I said earlier. So where it is gathering a momentum to take off or shoot out in either bearish or bullish direction. Did you see? So if it's gathering momentum, a choppy market shows you when the market is gathering momentum, trying to gather momentum to take off or shoot out in either a bearish or a bullish direction. I've made mention of that. So just for a recap, I mentioned 3 types of price direction or movement. I mentioned what? Ranging market. Let's go back. I mentioned ranging market. All right. I mentioned ranging market, and I said the ranging market is like this. Then I also mentioned our trending market, which has a downtrend like this, and also it has also an uptrend that looks like this, where it has series of higher highs and higher lows. The downtrend has a series of what? Lower highs and lower lows. Then I mentioned our ranging market, where we said the market is sideways and goes between support and resistance zones. Then we also mentioned the choppy market. Okay, just for a recap purpose. All right. So I mentioned the choppy market is an indecisive market. You are not supposed to trade that. All right. So what are the lessons for you to take up home from this particular video? Now, in this particular video, what I wanted to know, and is very, very important for every trader, is that it's very important that you make use of multiple time frame analysis when you are making your forex analysis. Now, it's always said that your H4 and your D1 time frame are actually used to know the direction of the market. You use your H4 and D1, it gives you entire picture of how the direction of the market is going. It tells you where the market falls into. These 3 market price movement we just saw now, you can actually see them clearly. If the market is ranging, if the market is going trendy, or if the market is going choppy, when you open your H4 time frame and D1 time frame. All right. Then when you come down to lower time frame, maybe from time frame like M5 to M15, you cannot spot out where there are breakouts. Yes, son. You spot out where there are breakouts. If there are breakouts from the ranging market, like we said, or we also spot out where you can actually make your entries. So the lower time frame for the M5 and M15 helps you to know where you can actually enter the market. Remember, the higher time frames is just for you to know the direction of the market. All right. You can also make use of what is called intra-day or intra-time, which is the 1 hour time frame. The 1 hour time frame also can give you a picture of the direction of the market, and actually also show you where there are breakouts when you come down to your lower time frame. So what are we trying to say? We're trying to say that we make use of what? Top-down analysis. A bigger time, when you look at the market from a bigger time frame, it gives you a clearer and an obvious picture of the market before you cannot decide where you want to enter your entry point at the lower time frame. So a top-down analysis is actually required. So take home, our vital notes to take home is our H4 and D1 gives us a entire picture in a clearer view of the direction of the market. Traders can take any time frame to analyze the market structure, how it will continue. All right. Always carry out a top-down analysis from the larger time frame to the lower time frame, so as to get spot entries and exit zones. Spot entries and exit zones. I take this again. Always carry out a top-down analysis from the larger time frame to the lower time frame, so as to get spot entries and exit zone. Market structure and market trends can be different depending on the time frame choosing to trade. Each time frame has a different market structure. That's what they are saying. As mentioned above, when using market structure to identify the movement of the price on the chart, it depends on the time frame you used. Each time frame has a different market structure. Mark that. All right. Using multiple time frame analysis to identify the trade opportunities and the flow of the market is widely used and very effective. Very, very effective. Making use of multiple time frame analysis. All right. So going from a larger time frame to identify the major peaks and valleys of an asset will give you areas of key support and resistance. From there, dropping down to the time frame you are actually going to trade on will make it a lot easier. Remember, the trend is your friend. Let me buttress on that. What they are trying to tell you is that when you look at it from a higher time frame, you understand? When you look at it from a higher time frame, you can identify the highest peak, that is the highest point of resistance, and the lowest point support zone, which is the valleys. Then you can now begin to spot your entry zones in your lower time frame. Is that very clear? And always remember that the trend is your friend. So if this video has been very helpful to you, please do not be stingy with your likes, and I want you guys to support us to churn out more educative videos to you, and by clicking your like and making your comments under the comment section. I remember your boy David Capable.